Right now, a handful of massive tech companies are pulling the entire US stock market upward. That kind of gravity makes investors nervous, sparking a very loud, very public fear that we are heading straight into a market crash. This diagram shows exactly why people are anxious. If you look at the total value of the S&P 500 today, just 7 companies take up 36% of the entire index. The other 493 fight for the remaining space. That is the most extreme level of market concentration we have seen since 1927. And almost all of that weight comes from one place: artificial intelligence. Since ChatGPT launched in late 2022, AI-related companies have generated 75% of the entire market's returns. They also account for nearly all of its capital spending growth. Companies are burning through cash at a blistering rate to build AI infrastructure. That massive spending brings up a second, entirely separate warning sign. Overall US stock market valuations, how much people are paying for shares today, are nearing the exact same peaks seen before the 1999 dot-com crash. We have a long historical record of what happens when a new technology sparks massive investment. Whether it was the internet in the 1990s or the railway boom of the 1840s, the historical pattern is identical: high asset prices, an explosion of infrastructure spending, and an eventual, painful fall. So the question is whether the current AI market is a ticking time bomb. To find out, we need to take the two specific variables driving this panic, market concentration and market valuation, and test them against the historical data. Before we test those variables, we have to look at what a financial bubble actually is. We usually treat them like dangerous glitches in the system, but historically, high stock prices driven by speculation and a fear of missing out are a totally normal, functional feature of new technology. Economists call this a productive bubble. When a new technology appears, investors throw massive amounts of speculative capital at it. A lot of that money is completely wasted on redundant projects and failed startups, but that excess capital successfully funds the physical infrastructure the technology needs to exist. In the late 90s, that money paid for thousands of miles of unused fiber optic cable. In the 1840s, it paid to lay down a sprawling network of steel railway tracks. Those physical networks paved the way for massive economic growth in the decades that followed. The bubble built the future. But that is zero comfort to the overeager investors who bought in at the peak and watched their portfolios get wiped out in the crash. Let's start the stress test with our first variable: market concentration. If a stock market is completely dominated by a tiny handful of massive companies, is it mathematically doomed to collapse? To answer that, we can look at an extreme case study. This is Canada in the year 2000. During the peak of the dot-com boom, a telecom company called Nortel Networks was building the optical technology the internet desperately needed. Its stock soared. It grew so large that Nortel alone made up 36% of the entire Canadian stock index. One single company held the same footprint as the 7 tech giants dominating the US today. When the dot-com bubble inevitably popped, Nortel went down with it. It became effectively worthless, and it dragged the overall Canadian index down 43%. This chart tracks the Canadian market's performance. Despite the massive plunge caused by Nortel, the line hooks right back up, recovering entirely by 2005. Pulling back globally, the Swiss stock market sits at 60% concentration. Taiwan is similarly top-heavy. Both routinely deliver strong returns. The data tells a very clear story. Across decades and across borders, a high level of market concentration has almost zero statistical correlation with a long-term economic disaster. Our first variable is a false alarm. That brings us to the second variable, market valuation. To measure this, economists look at something called the CAPE ratio, which stands for cyclically adjusted price to earnings. Simply put, market valuation measures how expensive it is to buy into a company today compared to the actual profits that company is expected to make in the future. It tells you how much of a premium investors are paying just to get a seat at the table. To see what happens when those premiums get disconnected from reality, we have to look at Japan in 1989. At the time, Japan was viewed as an unstoppable technological juggernaut. That belief drove their stock market valuations to unprecedented global highs. This chart tracks the Japanese market after that peak. The bubble popped, and the line never recovers. remaining flat for nearly 40 years. Overlaying the 1999 US tech crash shows similarly massive valuations, followed by a lost decade of zero returns until 2013. The data on our second test is definitive. While market concentration is mostly noise, extreme market valuation is a mathematically proven red flag. When people vastly overpay for future earnings, it directly correlates with depressed future returns. The reality is that no one can perfectly time the market. We will only know for certain if the AI boom was a true bubble in hindsight, years from now. But we do know that current US market valuations are objectively elevated. The data demands that investors moderate their expectations. The rocket ship returns the US market has delivered recently simply cannot continue upward at that angle forever. So if a correction is coming, the only reliable defense is broad diversification. We know this works because it saved people during the worst crashes in modern history. An investor holding a globally diversified portfolio during the 1989 Japanese crash was entirely shielded because they also owned the US equities that were rapidly rising in value at the exact same time. Even if you stayed inside a single country during a crash, diversification worked. During both the US .com bust and the Canadian Nortel collapse, investors who held value stocks, companies with low share prices relative to their actual fundamental value, continued to earn positive returns while the main tech indexes bled out. The main problem with diversification isn't mathematical, it's psychological. If you are truly diversified, it means you are guaranteed to own the absolute worst performing assets in the market at any given moment. You always own the losers. But enduring those losers is the mandatory price of admission. It is the only mathematical way to guarantee you will also hold the winners. And when the AI hype eventually meets reality, owning the winners is the only thing that will keep your portfolio intact.